Hello traders, and welcome to our Babypips course for today. We are in summer school, course 5 of 11, and we have considered 5.1, that is Heikinashi, and today we're going to be discussing about the Elliott Wave Theory, that is 5.2. And in this section, this course, we're going to learn about the Elliott Wave Theory, impulse waves, corrective waves, fractals, that is Elliott waves within an Elliott wave, then the 3 cardinal rules of the Elliott Wave Theory, and how to trade Forex using Elliott Wave theories, and then we'll summarize the Elliott Wave Theory. So as usual, let's just look at the outline, and here are the subheadings in 5.2, and yeah, let's get started. But before we begin, as usual, let's roll the intro. So welcome back to the Elliott Wave Theory, and back in the days, the old school days of the 1920s and 1930s, there was this mad genius. His name is Ralph Nelson Elliott. He was a mathematician, a professional accountant, and having studied the markets closely for about 75 years of stock data, Elliott discovered that the stock market, behave in a somewhat chaotic manner, right? And at the time, he was 66 years old. Here's Elliot, and he gathered enough evidence, and he came up with with his book, and he showed the world that this is the way the market is moving is because of external influences and the repetitive cycles of emotions of peoples and investors, and this emotions and whatever it is tends to move the market in a somewhat particular manner, and that if anybody can follow the manners in which the market is moving, right, he called it waves. Okay, he said wave of emotions of investors and traders and everybody, spurred by the news, spurred by events in the world and in a lot of things. So he said if traders can follow the waves, right, of the market repetitively, they can be able to spot the top of the market and the bottom of the market and put traders in a good position to maximize profit. Like everybody was like, wow, really? So how do you prove this? So for Elliot to prove his claim, he had to claim what he's saying, okay, and then finally he came up with his book, and he called it the Elliott Wave Theory. Everybody was interested, right? They want to know how you can be able to spot the tops and bottoms of the market, that way you can be at the right side of the market. Okay, remember, this was when stocks were being traded, not forex. This was way back between 1920s and 1930s, a pretty long time ago, over a decade. That was how Elliot came up with his theory. So Elliot, he claimed his work and he named his book the Elliott Wave Theory. Okay, now, but before we really go into discussing what the Elliott Wave Theory is there's something you need to know, or we need to talk about here, which is called fractals. Right now, what is fractals? Fractal is just basically let's say a road inside a road, or a rail track, or rail tracks inside a rail track. You have different rail tracks. Okay, like in a mega train station, you can have up to 5 rail track in one particular rail track. So trains can just come and go, like off and on like that. I mean, that's the best way I can explain it right now. So they say a seashell is a fractal, a snowflake is a fractal, a cloud is a fractal, a lightning bolt is a fractal, right? It is inside. You can get something inside within something. It's a fractal. So yeah, let's move on to the next lesson, which we are going to really begin studying the Elliott Wave Theory. Impulse waves. So what are impulse waves? So Elliot came out with a theory, and he called the movement in the markets impulse waves. He says the market moves in waves pattern of 5 to 3. And what is this 5 to 3 wave pattern? Okay, he said the first wave pattern is called the impulse waves, and the first 5 waves is called the impulse waves, that is the market is pushing. Okay, and the last 3 wave pattern is called the corrective waves. I really don't know if I should go so fast on this. I would love to go fast, but I think let's study this, not too fast. So here is basically a sample of the wave, the impulse and the corrective wave. Now I'm going to show you. So here is an impulse, first wave, and this is a correction, second wave, another impulse, correction, and another impulse. Okay, so these are the impulse waves when the market is pushing. 1 is the impulse wave, 3 is the impulse, it's an impulse wave as well, and 5 is an impulse wave. So this is the first pattern, okay, of the impulse wave: 1, 3, and 5. Then 2 and 4, they are correction. Now we do not want to confuse the waves 2 and 4 with the ABC pattern. It's very, very different, and we're going to discuss that in the next section, as you can see. So here is a picture of how the impulse wave is according to the Elliott theory. So a little addition of colors makes it beautiful, right? So it's very clear now. Okay, 1, 3, and 5, the market is pushing, and wave 2 and wave 4 is only a correction. So let's talk about let's analyze them in detail. Okay, so Elliot said the stock market makes a move, initial upwards move. What is going on there? Okay, this is when a small number of people know or heard about the stock, and they are the first set of people who invest in buying the stock. Okay, so when this number of people buys the stock, what happens? The market impulses off, moves up, okay, in an impulse. Okay, and what about the wave 2? This is the wave 1, right? When people, the initial people who bought a particular stock, maybe a new stock, or maybe it's just coming out, whatever it is, so they are the ones who bought first, and so we have the first wave. Now what about the second wave, which is the corrective wave? Okay, so the first group of people who bought the stock, right, and they bought here and prices rose all to this point, they now thought that the price of the stock, is overpriced. Okay, it's high enough. So what happens? They close their profits right here, and by the time they close the profits, what happens is that the prices of the stock will fall down. Now this wave 2, this is wave 2, when the price of the stock is falling down. Okay, now in wave 3, okay, which is longer than wave 2, what happened here is that since the price of the stock has fallen down, the people who did not buy during this first time, this first wave, they now consider this reduction in prices to be as an opportunity for them to get into the market. And by this time, the stock prices has gone all over on the news. It's already in the news. People are talking about the stock. They say, well, the stock is good, the company is doing great. And what happened is that a lot of attention has been drawn, and many people just jump into investing further in the stock. So this group of people in wave 3, they are much more higher than the group of people in wave 1, and that's why you see wave 3 length, okay, the impulse is much more longer than that of wave 1. So that's why the third wave is there. And now in wave 4, right, this is when traders take their profits. Those who came in wave 2, right, who entered during the wave 2, okay, and they are closing their buys. Okay, they say, man, this stock is so bullish right now, right? This was where it was before. It has closed above this previous high, and it is even more longer right now. So for us to be very secure of our money, of our investment, it's better for us to close our positions at this point here, and to close in many of their buys. Okay, and so that brings us to wave 4, where traders close in many of their buy positions, and that is why we see the prices of the stock fall back down again. And once the price fall down again in wave 4, okay, because traders have closed their positions, wave 5, which is the last wave, this is where those who could not, these are these people who could not get into wave 1, wave 2, wave 1 and wave 3, this is when they jump into the market, which is the last wave, and they jump into the market, and that brings us to wave 5, the final one. And yeah, that wraps it up for the Elliott Wave Theory. The waves, we're just explaining how the waves come and goes. Wave 1, wave 2, wave 3, wave 4, and wave 5. What is happening here? Wave 1, at the beginning, everybody, the few group of people who bought the stock first, okay, and in wave 2, people in wave 1, they are closing their positions, and that brings us here. And wave 3, people who could not get into wave 1 here, they jump into the market, and it is much longer because the price of the stock is now in the market, okay, and the news has carried it, and many people now just dump a lot of investment. I will see a huge rally to the top side, okay. And then in wave 4, investors in wave 3, they are closing their positions, okay. And in wave 5, those who could not get into wave 1, wave 3, okay, they get in here, and that brings us to the last push before the before the market reverses. So that is basically the explanation of wave 1, 2, 3, and 5. So that brings us to extended impulse waves. One thing we need to know is that in wave 1, wave 3, and wave 5, one of the waves is usually longer or extended than the others, irrespective of whatever happens. This is wave 1, wave 2, wave 3, wave 4, and wave 5. Wave 3 is always longer than the other three, the other two waves, okay, from wave 1 and wave 5. Wave 3 is always longer, and that is one thing you need to remember, and that is all about the extended impulse waves, okay. And there are a lot of theories that have come up now. It has been modified, and people have brought more ideas and whatever into it, but this is the basic. This is what Elliot himself came up with. So let's quickly go to corrective waves. So here we are in the next lesson, corrective waves, and in this lesson we're going to learn how the market corrects itself after the 5 waves. So the 5 wave trends are then corrected and reversed by 3 wave counter trends, okay. And here they are, the 3 wave counter trends, wave A, wave B, and wave C, okay. And what is happening here? The market is reversing from this push to the top side. Trend line has been broken, a retest, failed to make a double top, and the market is falling to the downside. So the ABC corrective waves is a counter trend, okay. It's once the 5th wave has occurred, okay, and the market pushed to the downside, finds support and push back up, but fails to create a new higher high, okay, and pushes back down again. This is the correction, A, B, and C. And what does it suggest for us? The market is reversing in trend, in direction, is falling to the downside. So this is the corrective wave pattern, okay, the A, B, and C. And this is for a bullish trend, and this is for a trend to the downside. You have wave 1, 2, wave 3, wave 4, and wave 5, and then we'll have the corrective wave pattern, which is the counter trend, wave A, wave B, and wave C. And we can see double bottom here, we can see the inverted head and shoulders pattern here, and more to that. So that's basically what this lesson is telling us. Then we have the types of corrective wave pattern. So according to Elliot, okay, there are 21 corrective ABC patterns, from simple to complex corrective wave pattern. So are we really going to learn about the 21 types of corrective wave pattern? Not at all. Even Babypips didn't teach that, okay. We're going to learn about the most basic one, which we can apply in all of trading Elliott waves. Okay, and there are three. Okay, so of all the 21, we have just three types of corrective wave patterns, corrective formations, that we are going to study. And when we learn about these three types of wave pattern, we'll be on a very good edge. Okay, so we have the very first formation, the zigzag formation, and this is how it looks like. So the zigzag formations are very steep moves in price that goes against the predominant trend, and wave B is typically the shortest compared to wave A and wave C. So wave A is very long and wave C is very long in the zigzag formations. Okay, and so what else can we learn? The flat formation, and here the flat formation is like a double bottom. Okay, and it's almost equal in all sides. Okay, so when you see a double bottom, just know that this is the flat formation. Okay, I think it's pretty simple, we don't have to spend a lot of time there. And then we have the triangle formation, and this is how the triangle formation is like. And many people whom I know trade Elliott waves, they always come up with this triangle formation. Okay, there are lots of them. Okay, but here let's just read it. The triangle formations are corrective patterns that are bound by either converging or diverging lines. You know what it means to converge and diverge, right? To converge is coming together, to diverge is opening apart. Okay, so the triangles are made up of 5 waves that move against the trend in a sideways formation. These triangles can be symmetrical, descending, ascending, or expanding triangles. So let's move on to the next lesson. So here we are in the next lesson, fractals, Elliott waves within an Elliott wave. So as we mentioned earlier, Elliott waves are just fractals. Okay, it means that in one particular wave you will have little waves inside of one wave. Okay, so like this, when you have one push, it will be a push like this will move like this. Okay, if sometimes even breaking the trend line before coming back up, before you have the second push to the downside, and it moves like this. You have the third wave and it goes up again. Remember, this is a wave, but see what price is doing: up, down, up, down, up, down. And when it pushes down, the fourth wave, 1, 2, 3, 4, the fourth wave here, okay, price coming back down again like this. And in the fifth wave, the same thing, going up again. So Elliott waves is basically movement of price inside each of these waves. Just remember that. Okay, you remember that. So it's not just going to be just one straight candle to the top side, one straight candle to the downside. No, I think you already know what I'm talking about, so I'm not going to spend much time about that. So you see the waves 1, 3, and 5. There are smaller waves inside the impulse waves pattern, and waves 2 and wave 4 are made up of smaller 3 waves pattern. Yeah, you get the idea. You know what we're talking about here. So to make it easy to label these waves, Elliott Wave Theory has assigned a series of categories to the waves in order of the largest to the smallest, and they are grand supercycle, supercycle, cycle, primary, intermediate, minor, minute, minuet, and subminuet. And according to the cycles, they take time. This grand supercycle is a multi-century supercycle. It happens about 40 to 70 years, and cycle 1 year to several years, primary a few months to a couple of years, intermediate to weeks to months, minor weeks, minute, days, minuet or minuet hours, and subminuet minutes. Okay, those are the names, the labels given to the movement in this in all of this movement. Okay, so let's see. A grand cycle is made up of supercycle waves, which is made up of cycle waves, which is made up of primary waves, which is made up of intermediate waves, which is made up of minor waves, which is made up of minute waves, which is made up of minuet waves, which is made up of sub-minuet waves. Did you get all that? It's a lot. But if you look at this picture here, you will kind of understand what we're talking about. In this impulse move to the top side, there are basic minuet, minutes, minor, and all these waves here. And this corrective wave to the downside, wave 2, we see what is happening here as well. And wave 3, we have another up, down, up, down, up, down. Wave 4, so it could be grand super cycle, it could be super cycle, it could be what have you. Okay, and this is wave 4, and from here we have wave 5. This is the low, and from here we have wave 5 rather. And then we have the corrective wave counter trend, the ABC pattern. A, this is the B, we see that B fit to create a perfect double top. Okay, and then we'll have wave C. Okay, so I believe we understand what we are learning here. So as you can see, the waves aren't shaped perfectly in real life. You will also learn it's sometimes difficult to label waves, but as you start your chart better, continue to label your charts, you get better at it if you want to trade with the Elliott Wave Theory. Okay, and I have a PDF, the book, the very first book Elliot wrote about his theory. I have it, and I'll drop a link in the description for you to download it so you can study it. Okay, so here we are in the next lesson, the 3 cardinal rules of the Elliott Wave Theory. So from what you have learned so far, you must have understood or know that to be able to trade the Elliott Wave Theory, you have to be able to identify the waves correctly. You must correctly identify the waves. That way you'll be able to trade the Elliott Wave Theory correctly. And there are 3 cardinal rules that you can never break whenever you want to trade the Elliott Wave Theory. Okay, and so let us discuss those 3 cardinal rules. Now, rule number 1. The wave 3 can never be the shortest of the impulse wave. Cardinal rule number 2. Wave 2 can never go beyond the start of wave 1. And the third rule is wave 4 can never cross in the same price area as wave 1. Let's illustrate here. Okay, I have me a pen I can use, and let's use a black line. No, let's use a red line. Okay, good. So this is wave 1, 2, 3, 4, and 5. Now what we are learning here is this: wave 3, which is this wave, okay, can never be the shortest. It must be the longest of all the waves. It must be the longest of wave 1, wave 2, wave 3, and wave 5. Then another thing we have to take note is wave 2. Wave 2 can never go beyond the start of wave 1. Wave 2 should not come down to this level here. If it does, it's wrong, and your trade or your wave is invalid. Okay, and then wave 4 can never cross the same price area as wave 1. So this is wave 4 right here. This should never come down to, even wave 2 talk more of wave 1. If the prices fall to this area here as wave 1, this Elliott wave pattern you're trying to trade is invalid. You can't trade it. You must never take that kind of trade. So those are the 3 cardinal rules of trading the Elliott wave. Okay, so next we have Elliott wave trading guidelines. So there are lots of guidelines that will help you, but let us discuss just this trade here we have here by Babypips quickly. Okay, now one we need to take note of is that sometimes wave 5 does not move beyond the end of wave 3. This is called truncation. Let's do this again. 1, 2, sorry, that color isn't good enough. Let's do this again. Okay, 1, 2, 3, 4, 5. It doesn't move beyond the end of wave 3. Okay, and what is it called? It's called truncation. Okay, learning here, and this is what we call also double top. Price moves down like this. You will learn a lot of stuff as you trade, right? You see many things, and sometimes price just begins to bounce up and down and up and down. Remember, that's no longer an Elliott Wave Theory. So what we are learning here is that sometimes price will never move beyond the end of wave 3. Okay, so wave 1, wave 2, wave 3, wave 4, and wave 5. Price will just sit around this area, and this is what is called what truncation. And next we say we are learning. We said wave 5 more often than not goes beyond or breaks through the trend line drawn off it. More often than not, it goes beyond or breaks through the trend line that is drawn off of it. That's another guideline. So what are we saying? It can mean this. Let me draw another proper wave. Okay, so another guideline is wave 5 more often than not goes beyond or breaks through the trend line drawn off. So let's say if we have a trend line drawn off, wave 5 might, this is 1, 2, this is 3, this is 4, this is 5, right? You see, if you put a trend line here, right, horizontally, wave 5 sometimes breaks through it. Okay, so that is what this we're learning. At least that is what I understand. And don't crucify me, please. And then wave 3 parallel to a trend line connecting the start of waves 5. Let's try to understand what is being said here. So here is wave 1, and here we have 2, and then we have wave 3, okay, and wave 5. It will be just both parallel lines. I think we understand what is being said here. At this point, and at this point as well, they will all be parallel lines. Okay, I think we know what parallel lines are, right? They move side by side like this, and at least that is what I understand. I'm not claiming I'm a genius of Elliott Wave Theory. Okay, I'm not even a genius at Forex. So now wave theory tends to be very long, sharp, and extended. I think we understand that. We know that. I've said that before now. Okay, so this is wave 3. It tends to be a trend line. It tends to be very long, sharp, and extended. And waves 2 and wave 4 frequently bounce off Fibonacci retracement levels. I think we've done Fibonacci already, so we understand what that means. So wave 2 and wave 4, they bounce off the Fibonacci retracement levels. And before we go to the next lesson, let's look at these pictures here. You see wave 3 can never be the shortest impulse wave, and wave 2 can never go beyond the start of wave 1. Wave 4 can never cross into the same price area as wave 1. I think we've understood this. So let's move to the next lesson: how to trade Forex using Elliott Waves. This is where it gets interesting. How to trade Forex using the Elliott Waves, okay? And this is what majority of us want to know. So according to what we are learning, we will see how we can take setups and apply our knowledge of Elliott Wave to determine entry, stop loss, and exit points. Okay, just like you're surfing on the sea or on the beach. Okay, so hypothetically will most probably be a right scenario, okay, according to what we're learning from BBP. So let's begin. You see that price of the market has bottomed out and has begun a new move. Okay, so when we say bottom out, it has come to a very much low, and it's been finding support in that area, and all of a sudden it's trying to push up. Okay, so you see price has bottomed out, okay, in the very low of the low, and you want to take a trade. Okay, so what we're going to identify is a first wave. So once you get the first wave right to the top side, the next thing you want to do is try to identify the second wave, and you find out that price, okay, topped out over here, highest high, a new high has been created, and price has been falling down. So since price has been falling down, you are observant, you are watching, and you are interested already, and you want to take a trade. And how do you take a trade? You go back to the rules of we learned earlier on. Our cardinal rule number 2 says that wave 2 can never go beyond the start of wave 1. Okay, and waves 2 and 4 frequently bounce off Fibonacci retracement levels. Okay, so here is wave 2 and here's wave 1. Wave 2 did not come to the beginning of wave 1. Okay, we just said that wave 2 and wave 4, they bounce off Fibonacci retracement levels. So all we have to do is to place a Fib tool on the chart and see how it goes, if it's going to bounce off or not. And so here we go. We have the Fibonacci retracement levels from the start to the high of wave 1. So you put your tool here, you draw it from here, from the bottom down to the top, and it will give you the Fib levels. Okay. And you have seen that the price of the market has broken 382, it has broken 50%, 500, it is now coming to the 618 area. Okay, and we learned earlier on that this level of ratio 0.618 is a very tender ratio. Okay, price find it difficult most of the times to break this level off of a retracement. Okay, and so you see, okay, well, it's a time to buy. And what you're going to do, you're going to get into this market. Okay, and so now we have satisfied cardinal rules number 2. We know where to place our trade. We know prices is bouncing off that area of ratio 0.618, and then we also want to get the probable price movement, how far the price will extend to the upside of wave 3. Okay, so inside of this area here, okay, with levels 618 and levels 500, okay, of this move to the top side, you find a position to enter into the market. You might enter here, you suffer a drawdown, and if your stop loss was here, you'll be good. The market did not come down to hit your stop loss, and then the market at first was ranging. Remember, this is a daily time frame. Okay, so you might be sitting in this area for like 1 2 3 4 5 6 7 8 9 10 11 12 13 14 15 16 17 18 19, like almost a month. Almost a month price was within this area. Okay, and in the second month price broke above, came back down, broke above, came back down again, and created a new high. This is wave 3 already. Okay, so that's basically how it is. Use your Fib retracement levels to look at the area where wave 2 will probably stall and find an entry right there. So that is how you get into the market, having identified the very first wave. Okay, you have to understand this will take time, lots of time, and lots of practice and practice and practice. I myself, I hardly do trade the Elliott Wave. I don't. Okay, So let's move on to the next scenario. That I don't doesn't mean you can't. I mean, you can do it. Okay. So this next scenario is like this. Let's use our knowledge of the corrective wave patterns to grab it, those pips. We have seen the price. This is a downtrend. We have seen price has topped out. Price topped out of this area here. We have wave one. We have what did I just do? I'm sorry about that. We have wave one right here. This is wave two. We have wave three, wave 4, and wave 5. Now here is a corrective wave pattern. Okay, remember the ABC. This is the A, this is the B, and this is the C. What is happening? Price is trying to change course, okay, from the downtrend to an uptrend. Okay, so that is the ABC pattern in a nutshell. And once price changes course, something is about to happen. So we counted 1, 2, 3, 4, and 5, and we have also spotted the A, B, and C pattern. Okay, and another thing we have to also notice is that the price hasn't been able to break above the C, come back to retest it and trade up. But what we're seeing right here is a bunch of weak rejections, price just ranging inside of the ABC pattern. And as we learned earlier on, when we see a corrective pattern like this, we know this is a flat pattern. Okay, it's flat according to the Elliott Wave Theory, and it's also a reversal pattern in the market, but not all the times it will. So we just can base our formation or our trading on that. According to this trade, with what they did, they spotted this great indecision here. You see this weak rejection, kangaroo tail, whatever you call it. This is a doji, and we see these two candles, they close side by side. Okay, and there's no winner in these two candles here, and so this is a very great indecision. 2 days indecision, another 4 days indecisive candles. Okay, so where is the potential of the market? Okay, maybe a new wave wants to occur. Maybe the trend is still to the downside, because irrespective of us having a flat pattern, we should expect price to go up if the trend is going to change. Okay, but since the trend is not going to reverse, okay, to the uptrend, and if it's going to continue downwards, we can expect a new wave pattern from here to the downside. So according to our Babypips, they say this is a potential sell market. We can place our stop loss above structure, and then let's see how the market goes. Now, trusting your Elliott Wave skills, you go ahead and sell the market. In the hopes the price is catching a new impulse wave, you place your stop loss a piece above wave 4 in case your wave count is wrong. And what happened? This one was your uncle success. You won this trade. Okay, so I'm not sure if you would have entered here, right? I'm not sure. I myself, I wouldn't. Okay, but if I see price break below this level, take out these lows, come back for a retest, continue to the downside, like my mentor always say, this is where we want to take the trade. Okay, and place our stop loss here, and this one is a banger. We won this trade. Okay, so that is that for this trade. Our Elliott Wave patterns or analysis or knowledge has helped us to be able to win this trade. Okay, so now we have won this trade, and what next? Let's go and flex some money in Vegas. So let's come to the last lesson of the Alias Wave Theory, summary of the Alias Wave pattern, or the Elliott Wave Theory rather. Elliott waves are fractals. We know what fractals is already: movement inside another movement. Okay, each wave can be split into parts, each of which is very similar copy of the whole. Mathematicians like to call this property self-similarity. A trendy wave market moves in a 5-3 wave pattern, and we know what the 5-3 wave pattern is. 1, 2, 3, 4, 5. The first 5 wave pattern is called impulse wave. Impulse wave. Okay, so these are the impulse push to the top side. One of the 3 impulse waves, 1, 3 or 5 will always be extended. Wave 3 is usually the extended one. This is wave 3. Then the second 3-wave pattern is called corrective waves. Letters A, B, and C are used instead of numbers to track the correction. So we have letter A, let's just change its color. We have letter A, we have letter B, and we have letter C. Waves 1, 3, and 5 are made up of smaller 5-wave impulses. Smaller 5-wave impulse pattern, while waves 2 and 4 are made up of smaller 3-wave corrective pattern. There are 21 types of corrective patterns, but they are just made up of 3 very simple, easy to understand formations. The 3 fundamental corrective wave patterns are zigzags, flats, triangles. Do you still remember that? Zigzags like this, okay, flats like this, and triangles looks like this, okay. A symmetrical triangle, ascending triangle, descending triangle, and I think symmetrical is like this, and we can call this one ascending, and we can call this one descending triangles. So let's clear our charts. Let's go to the 3 cardinal rules. 3 cardinal rules of trading the Elliott Wave Theory. Rule number 1: wave 3 can never be the shortest impulse wave. Then wave 2 can never go beyond the start of wave 1. Wave 4 can never cross in the same price area as wave 1. I think we've explained this from before now, times and times number again. We've been looking at this again and again. Congratulations. This is Mr. Elliot, the mathematical and accountant and the mad genius who developed a whole book on Elliott Wave Theory. Don't get me wrong, many traders I know are using the Elliott Wave Theory to make a phenomenal amount of money from the forex market, okay? And you too can do that if you are interested in trading the Elliott Wave Theory. So kudos to this man. Even though he's no longer alive, we appreciate the work he did, the theory he came up with, helping a lot of us to understand the market, how the market moves in waves and correction pattern. So my friends, this is the end of Elliott Wave Theory. And like I always say, share this video if you like it, smash the like button, subscribe if you haven't, and until next time, I wish you success.